on my screen a minute ago. I think that's Anchor's first.
Regions is first.
Regions, I'm sorry. My memory, what shows my memory? I should never say about my memory. Regions is first. I'm very sorry.
No, that is completely fine. Good afternoon, everyone. Thank you so much for having Regions present at this virtual board meeting. It is definitely becoming the norm. I haven't done quite as many as Scott said he has done, but I'm getting a little bit better at these video conferences or video meetings. So I'm going to go through some information on the custody accounts that Regions has for the retirement plan. Do I have the ability to change the pages, or do I need to let you know, Keisha? Okay, I assume that's Keisha's changing it for me. Thank you. I have a page on plan assets, cash flow summary. Obviously, contributions, distributions is a lot of what we're handling for you all with the pension plan. The individuals who have access online, and then just in these unprecedented times, I put some information in there that I wanted to show to you. And certainly could hand it off to Keisha or whoever thought it was appropriate if it's something that you wanted to share with the employees or the pensioners. So you can flip the page. Plan assets. This summary is actually as of May. So depending on if Dave or Anchor is doing March numbers, this will look a little bit better. And this, of course, is the assets that Regions custodies. So it's not the full plan. It was at 90.3 million. We have 5 separate accounts, 3 manager accounts with Anchor, Wells Fargo, Integrity. Then we have a mutual fund account and the receipt and disbursement account. There's an asset allocation down there. Again, that's for what Regions is holding, which is majority equity. You want to flip the page? Cash flow summary, I included fiscal year to date 2020, 10/1 through April 30th. And then I wanted to include full year end 2019, so you could at least see the differences and trends that may be going on from one plan year to the next. So if you look at contributions year to date 2020 from October 1st, 2019 through April 30th, little over 5 million has been received in. We received the employer contribution of 4.8, almost 4.9 million right at the beginning of the plan year. And then year to date, we've had about 205,000 in the employee contributions. So you're actually already ahead 7 months in to this plan year versus last plan year, which was a total of 5,069,000. And then from a distribution standpoint, year to date, broke it between pensioner and lump sum. Year to date through April, you're at about 3.3 million of the pension payments, which is about, and I don't have it on here, but I looked it up, that's about 1,700 distributions for the pensioners that have gone out. And then lump sum payments sitting right around 30,000 at this point in time. There's only 3 that have been processed year to date through April, which puts it at about 3.3 million. And then looking at last year, total of almost 7 million went out in distributions last year. Pensioners were at almost 5.3 million, which was almost 2,800 total pension payments. And then you can see there's a significant difference in the lump sum payments that went out. There were 13 lump sum payments in total last year, but you had some fairly high lump sum payments that went out last year. So that's why I don't think you're going to probably reach that in this plan year.
Well, those are probably just people coming out of the drop, right, Mary?
Correct.
Yeah.
Correct. And so you'd obviously probably have a very good idea of who those are. And then just always want to make sure you're aware of who we have set up for statements. I don't think that there's any need for changes. We've got Keisha, Larry, Treasury separate from Larry, ANCO, obviously, Foster and Foster, Robbins, Geller, Ridman, and Dowd, and then the investment managers for the various manager accounts, Anchor, Wells Fargo, and Integrity. So if there's anyone that you ever need added or obviously removed as well, you just let us know and we get the paperwork together for that. So if there's any other questions, anything I can answer specific to the pension plan, if not, then I just wanted to include some information on some resources that Regions has available. Obviously, as I mentioned earlier, given the unprecedented times that we're in, a focus on financial wellness, a focus on resources outside of going into a branch or a bank is necessary. And so Regions has really been vamping up their financial wellness program called Next Steps. So they've been doing webinars. 3 webinars are listed there: managing your money, your credit report, and how to bank without visiting a branch. I mean, I think branches are starting to open slowly, but typically right now it's by appointment only. So weekly webinars that are going on, certainly something we can share. The website's down at the bottom. And then on that same website, if you turn the page, there's also a plethora of additional tools and resources. There's calculators, there's podcasts out there, worksheets to help you with various different financial topics, and they can explore on their own if they so choose. There's obviously no cost to them for using any of this. And then the last page that I'll discuss is the next one. What I think is really interesting, and certainly in a time where if you have employees, which I'm sure you do, that have kids, and there may not be any summer camps or anything that you can do with them, Regions is partnering with Everfi. And they have digital courses for K through 12, and it's not just financial wellness, it's character building, it's mental health. There's various different topics that you can have K through 12 students sign in and take their courses and help them with various different topics. So all of that is on that Next Step website that I talked about. So if you're interested, I can send that information to Keisha. Welcome to share it with employees. I mean, I think some of it might be helpful to the pensioners, a little less so, obviously on the Everfi side, but just wanted to make you aware, just given where we are right now, that there's some additional digital resources available to help from a financial wellness standpoint. And I think that is all that I had to discuss today. So as I said before, I'm happy to answer any questions you have. If not, I can turn it over to the next speaker.
Well, is there any questions of Mary? I'd like to take time for everyone to read this important disclosure before.
Please do. That is why it is included.
And then our reporting issues and all that's all been ironed out behind us, and we're moving ahead well.
Yes.
Okay, very good. We're hearing no questions of Mary, then we'll move to the next part of the agenda.
Thank you, Mary.
Thank you very much. And that'll be Anchor.
Thank you.
Well, thank you, Mr. Chairman, members of the board. My name is John Bowles. I'm the client service representative, Anchor Capital, to your account. And with me today again is your portfolio manager on this mandate, William Hickey. In the time that we have, I'll just give a brief firm update in terms of what has occurred since we effectively shut down our offices back in mid-March. Some change in terms of personnel, how we're doing on the financial front, some additions to the firm. And then I'll review the performance and then hand it off to Will with a discussion of what has worked in the portfolio, what hasn't worked, and outlook, and address any questions that you may have. So with that, thank you, Keisha. Just on page 1, in summary there, the assets as of close of business last night are just a little bit north of about 8.2 billion. So as you've probably seen since the beginning part of April, the markets have had a very nice recovery, as dramatically as they decreased starting on February 23rd. They have since sort of turned around and dramatically increased. So that has increased the firm assets to, again, about a little bit above 8.2 billion. In terms of personnel, very proud that since we last met, we added some senior firepower to the investment team. an analyst by the name of Niraj Majahan. Niraj comes to us, he's local. He spent almost a decade at GMO. So he brings to us a significant amount of value, expertise, and we're very pleased to have him on the team. In addition, Diane DeBono, who has been with the firm for quite some time, has assumed the role of Chief Operating Officer and Chief Compliance Officer. And with that, we also hired a full-time compliance analyst. So very pleased to have both Diane and Michelle Demir now running not only the operations end of the story at Anchor, but also the compliance aspect. And lastly, from a personnel perspective, proud to announce that, we mentioned this last time, that both Bill Rice Jr. and Jennifer DeSisto were co-CIOs. Well, we have effectively transitioned Jennifer now to a full Chief Investment Officer role. I'm very pleased that she's now leading the investment team at the firm. Since the shutdown of the firm in the middle of March, I'm also pleased to announce that all the functions of the firm, research, trading, portfolio accounting, everything is working flawlessly. All 50 employees are working very well from home. And while we miss each other, I think utilizing tools like this has made it very conducive to getting the work that we need to get done on your behalf. And with that, certainly with the market having its issues in February, what we've seen is a tremendous number of opportunities in terms of valuations being at historical lows. And I won't take any thunder from Will, but needless to say, the investment team has been working quite diligently, and you'll see on the succeeding pages that there's been a number of transactions in the portfolio that have occurred because valuations have popped up on our screens, our search screens, that have indicated that some of these values are really, again, at historical lows. So that's pretty much it from a firm perspective, unless there's any questions.
Any questions? Hearing none.
Well, then,
continue.
if I would direct your attention to page 3 in the presentation, and just to reconfirm why Anchor in your portfolio. And the chart that you're looking at on page 3 is a risk return chart. And effectively what we have there is the all cap value strategy since inception of January 1994. Now I realize that you've been with us since 2012, so a little shorter time period, but this shows the inception of our all cap value strategy, which, as you can see by this chart on above, the Anchor all cap value has been trending towards what we call the Pacific Northwest. And there's where you get the better return with a lower level of, most important, lower level of risk. And we compare that to not only the appropriate index here, the Russell 3000 value, but also the Russell 3000 growth for the same time period, and the core index. So you're looking at Anchor's strategy, again, providing a better return at a lower level of risk since inception of the fund. And just to put this into perspective,
I think we need to be on the next page.
Keisha, can you move it to page 3, please?
Thank
Sorry.
you.
There it is.
And if you look at the bottom of this page, we like to put things into actual market events. And so we all recall the global financial crisis. And you can see there the net performance in comparison to the index, about 14% better in terms of us and our ability to protect principal in down markets. The U.S. government downgrade was about roughly a 5% protection against the index. And I've added the recent pandemic to the equation, and we protected to the tune of about 3%. So very proud of the fact that we have a quality portfolio on your behalf with companies that we believe are going to be effectively positioned to weather the shutdown of the economy and come out of this much, much stronger. Any questions on page 3?
Questions? Continue, please.
Page 4, this is a drawdown analysis on page 4, Keisha, if you could turn that page. So now if you look to the very far right, what you see is the beginning of the pandemic. And to the far right there, your all cap value strategy is in the blue. I'm sorry, Keisha, you can go back to 4 for a second? Sorry about that. There you go. There you go. So what you see there is that the all cap value is in the blue in comparison to not only the Russell 1000 and Russell 3000, but also the S&P. Now, the important thing to note here in this chart is that the downturn is less in terms of the all cap value. But most importantly, if you look down at the bottom of this chart where you see the anchor all cap value composite in terms of what we call peak to trough in terms of the drawdown analysis, look at the third column, recovery. And that's important because what that shows is that the recovery is almost twice as fast in our strategy versus the indices. And that, again, is a tribute to the names, the quality names that Bill and Will and the rest of the investment team select in these portfolios. I think the next page, on page 5, again, it's just sort of a summary again of not only the risk reward analysis in comparison to its appropriate indices, but also, again, it just shows the returns as well as the level of risk that's taken in terms of standard deviation and what we call modern portfolio theory statistics. And again, here we believe that the all cap value certainly has demonstrated its ability not only to generate a very consistent return above its respective indices, but again, at a much lower level of risk. Now, these are all relative comparisons. I think the next page, page 6, is really where the rubber hits the road in terms of, well, how do you stack up against your peers? And for this particular page, what we're utilizing is the eVestment Alliance, which is a independent group that puts together universes of similar managers and similar styles. And here we're looking at the US domestic all cap value equity universe. So it's the returns of about roughly 200 other managers that are deemed and categorized appropriately as our peers. And the left side of what we call these floating bar charts is the return aspects. The right side is a level of risk. And here's what you can see on the return side. We are in the quadrangle, and what you see is Anchor has consistently performed in the second and almost on a 3-year level and a top quartile basis in terms of comparison to the returns delivered by not only the other managers in the universe, but also to its respective indices. Same thing goes, so you look at the return is the upper left comparison. Below that is alpha, the excess return that is delivered above the index because of our skill. And to the right side of this page is a level of risk. And here again, if you look at the very upper right graphic here, standard deviation is a level of risk. You can see again, the Anchor all cap value is taking less risk in order in which to generate the returns in comparison to its indices, and most importantly, in comparison to its peers. So here again, you're looking at this at a 1 year, 3 year, 5, and I know that you've only been with us for 8 years, but I think certainly I know a lot of folks have looked at, what it's hard to really identify these days, what is a true market cycle, but I think, looking at a 3-year rolling 36 months is a good indication of the type of consistent return and level of risk that we would take on your behalf. And I think very proud to say that we're falling right in there between the first and second quartile in many of these categories. Any questions?
Questions, anyone? Continue, please.
Okay. I think on the next page, we summarize the performance year to date. This was through 5/20. You can see the return of the plan is down 16.87%, but in comparison to the benchmark of down 19.5, call it, still about 300 basis points of outperformance. I can tell you that as of close of business last night, your portfolio is now going through 5/27, is down 12.8%, and the index is down. Bear with me. Is down 15.6. So again, some about a little over 300 basis points of outperformance there that we continue to provide through close of business last night. That's pretty much on the performance side, unless there's any questions.
Is there any is it feasible if the market starts the way this week's been going, that that we could at least break even by end of fiscal year, or are we too far into it?
I'll let Will also add to that. My perspective is that I think one of the distinct advantages that you have in this portfolio is the fact that it is a all cap mandate. And so while when we look at the holdings, you'll see a number of large cap holdings, and it's certainly tilted that way. We also have a fair amount of mid cap and small cap names in here as well. And if you look at the NASDAQ in terms of, since April, I guess it was April 1, it's up almost like 7%. So I believe that, with the, the defensive quality large cap names that Will has in the portfolio, combined with some of the alpha opportunities and some of these small cap quality names, that we stand a good chance. We stand a very good chance of breaking even. And maybe who knows, depending upon what the recovery looks like, whether it's we talked about this earlier, whether it's a U, a V, or a hockey stick. I think it's all, the market will, as we've seen already, the market has turned because there's been less negative news, in my opinion, and as opposed to more positive. So I think the more you see diminishing negative news in states like Florida coming back very strongly, other states as well, in terms of coming out of this lockdown, there's a very good chance.
Hey, Larry, this is Larry Webb. I'm thinking that it's going to be how you define break even, because we're trying to get to zero, and there's a lot of opportunity costs we've missed now for the past 5 months. So I don't know how you really would define for our pension plan really zero as a break even, because we should have been earning positive earnings for this entire year. So I think we'll be quite negative for some time. And not breaking even.
7 3/4 approximately. And
so
we're going to at least be there. Yeah, zero, we're still that behind. I get that and the other opportunities, but I mean, coming out there, it beats coming out at, and I'd like to be at the 7% growth, but I think I was being very optimistic if I'd asked for that. But I was just hoping we don't finish the year out at, at minus 12 or 11 where we are today.
Yeah, I just wanted to be careful on that term break even, because
no, I mean break even would be 7% growth. I get that.
I mean, reach back to zero.
Yeah, this is Dave West, and I just wanted to provide a little follow-up comment there. As far as the plan as a whole goes, I think there's a very good chance that we can close out the year in positive territory. But I have a little bit of a follow-up question or a request of either Will or John. What we're discussing right now has been the most problematic area, the worst performing area of the equity market, and that's value stocks with a mid and small cap orientation. And as John communicated, Anchor's an all cap value manager, so their pond they're fishing in is all inclusive. But this area, they've done a superb job in finding better opportunities and protection on the downside. So I guess my request is, as you go through your presentation and kind of your attribution and forward-looking thoughts here, the return differential between growth stocks and value stocks is increasingly disparate up until maybe the last week. Could you comment on that? And John, I think you gave a good example or discussion on how you guys were able to maneuver through a very difficult markets opportunity set. But if you could maybe comment on, holistically what the prospects might be for the value style of investing, value stocks going forward, and maybe incorporate that a little bit into your comments. But I think everyone needs to be aware that Anchor's done an excellent job, and they're operating in the most problematic what has been the most problematic area of the equity market.
Great. Will, you want to,
Sure.
Good segue to yourself.
Absolutely. Hi, everybody. It's Will Hickey. Good to see you all again, kinda. I think that's very topical and timely, because in talking about the first quarter, I think what's really important is where we are now. If you look at the first quarter, at one point on March 24th, the indexes were down well over 30%. I mean, intraday. And so volatility is the name of the game in this. And I think where we have set ourselves apart longer term is being able to take advantage of that volatility. And I think I'll go through, what we did then at the end of March and going through April in terms of doing some changes. I think going forward here, the growth indexes are dominated by the FANGs. We've all heard this, right? It's Facebook and Apple, Amazon, Netflix, Google, and probably something like Microsoft. So even we as value managers who have owned for a long time stocks like Microsoft and Apple, the weighting of those stocks in the growth indexes is kind of almost gross, I think is the word. Meaning, if you look at those five or six stocks, they make up about a quarter of the indexes themselves, and have accounted for a large portion of the move in those indexes. And so what that shows you short term is that when money flows into the market, it flows into the most liquid. So in the short term, your most liquid stocks will go up the most, and then in volatile periods going down, everything goes down, but sometimes the smaller and mid-cap stocks may go down more in the short term because they're not as liquid. But that's the markets that we deal in. I mean, having seen these bear markets for 30 years, it's kind of the same story every time. This one was a little bit different in that, we got thrown into a recession, and at this point, it doesn't really matter why we're in a recession, we're in it. So I think going forward, as the market kind of settles out here and money isn't just kind of going in blindly. I mean, a lot of the names that we own have already moved, but they're probably going to move more. I think even though we've done well in down periods, as John says, and we do really well, but playing in the market that we play in, playing in these all cap value stocks, in that downturn, especially through the end of March, we had a lot of smaller cap names that were down excessive amounts. I mean, we didn't sell them, but they were just on excessive amounts, saying this is just showing that short term in the market is not as liquid as you might assume. And so all you can do is just hold on. And I think that's what's going to happen now going forward. So you're going to have a sorting in the market. I think you may have kind of a scenario going forward, kind of like we did back in 1999, where money pours into these large cap growth companies and drives them to excessive valuations. And on the other side, kind of like happened from 2000 till 2008, value is going to shine, but the value is not going to outperform until this growth run kind of exhausts itself. And what usually kind of exhausts it is that they hit the kind of excessive valuations, which really can't be held. Does it help to answer the value versus growth?
Yes,
Everyone
thanks, Will.
Get a good answer, Dave. Are you
Dave?
satisfied?
Yeah, thank you.
Okay. So here to talk about the first quarter, but as I said, I think it's more important kind of where we are. At one point, being down almost 30%, what we really took stock of, and it's something that, having managed through a lot of other downturns, you could kind of see the recession coming, and you'd kind of be trimming stuff that you knew would be sensitive to the economy or companies that had too much debt. And so kind of coming into February through January, and we had started to trim a little bit, meaning that we had seen some businesses that we thought were going through secular changes and sold out of. And that was only heightened by what happened in March. I think like a good example is coming into February, we sold out of a company called Cinemark Holdings. So Cinemark is the second largest movie theater owner in the country, and had been really fighting a battle of trying to make their seats more bigger and comfortable, and fighting a battle of people really not wanting to go see movies. It paid a good dividend, so we held on to it for a number of years, but really saw some secular changes and sold out of it. So our timing was, I would say, a little bit fortunate in that when March hit and movie theaters all being shut down, it got absolutely hammered. So we're able to kind of make that change, helping us, I think, and then be able to roll it into some new names. One other name that we sold in the first quarter when we first saw this slowdown was happening was CDK Software. So CDK makes software for auto dealers, which has been a good kind of steady business, and it goes along. We kind of saw when this lockdown happened that we think there really is going to be a secular change in use of autos. I mean, not just a short-term change here where people are in their cars a lot less, and that going home with work from home, changes in offices. We really think there's going to be a secular change there. The changes we made. This is where we're constantly vetting companies, constantly looking for quality, constantly looking to try to upgrade the companies that we own in the portfolio. So at the same time, we're able to add what we think kind of brand names that in the past were probably too expensive for us as value managers. And number one would be Estee Lauder. Estee Lauder's been an incredibly cash generative business, through their stores, online, global, skincare, fragrance. Stock really got hammered back in March because they had to shut their stores. We were able to pick it up at a very nice valuation. And I think our thought was, okay, over time, sales are going to migrate online even more than they are now. So if you look out 3 or 4 years and most of your sales are online, they make more money off products they sell online than products they sell in their stores. And so that's worked out well. 2 other names, kind of large caps that we had watched and took advantage of the weakness to buy. One is PepsiCo and one is JP Morgan. And these are just large brand name companies. At the bottom in March, both their dividends got close to 4.5%. We checked it out, realized they wouldn't have to cut their dividends, and we were able to buy them. So these stocks have come back nicely. And we think looking at 5 or 6 years, even in a kind of muted market environment, if we can own stocks that are paying a nice dividend, we're gonna do okay. I think of note is that we've never really owned a lot of retail stocks. One, they're kind of a growthy valuations got kind of out of hand, but 2 that we have owned and it's really helped is one is Dollar General and 2 is Walmart. It's really interesting in this time how market share shifts have happened and how quickly they've happened. But companies like Walmart that have really made an effort over the last 4 or 5 years to go online, work on customer service, work on curbside pickup, have really done incredibly well. So on the list there, I think if we go to page on the presentation, if you go to the next page, these are the year-to-date purchases and sales. I've gone through some of them. I think of note is our turnover, meaning the amount of purchases and sales we did during this time was a little more than average due to changes in circumstances, where we saw fundamentals in companies changing and saw opportunities to buy other companies, we had to jump. And so if you look here to where we are now in the second quarter, we've been able to keep up with the market going forward. As John said, it's been interesting. The last 2 months, you've gone from a -30 to a -12. And I think that goes to having been through these bear markets. You got to take advantage of them. You got to deal with the volatility because it's going to happen. And I think going forward, equities really are one of the only games in town. I'm sure you've seen the bond market. I mean, your bond managers have probably done great. We manage some bond portfolios ourselves. This has really been an incredible time to get treasury yields under 70 basis points, going out to 10 years. But what it does is that it makes the cost of capital, right, for companies out there a lot cheaper. And I think if you really are in companies that can generate cash, pay a dividend, going forward, it's really going to. So I'll stop there if there's any questions.
Any questions from any of the board members? Hearing none, you may continue. Thank you.
Okay, thanks. I think just for looking back at the first quarter, like what hurt and what helped. I talked a little bit about what helped has really been in quality companies that could take advantage of it, and getting out of some companies that we determined quickly, we're going to get hurt. What really hurt us is holding on to oil. Over the last 20 years, oil has proven to be a pretty good dividend company. Price of oil, has fluctuated really between kind of $30, $40 and $100. Companies can make money. That crash in the price of oil starting in March and then trading for a short time, they're kind of up in the high 20s, 30s. It's actually destroyed a lot of companies. Not ones that we own, but it's destroyed a lot of companies. And so that hurt us, even being underweight, hurt us on a absolute basis. We think going forward, oil is going to be, it's going to be a tough slog. But what's going to happen here is that with oil being so cheap and a lot of the marginal players going out of business and a lot of capital now that's looking for oil, over time, supply and demand will balance. But I think the destruction of gas demand in the U.S. caused by this lockdown is really unprecedented. It's just fascinating. We have oil. If you're a gas demand down 50%, 60% for some weeks, it really has thrown stuff into a disarray. But I think what's going to do in kind of the natural cleansing process of the market is that, you're going to have a lot of. And I think just to make a comment where we are and going forward, this business is ever changing. You got to always be using your judgment, always looking, always turning over stones to figure out what's going on. I think now the evaluation metrics, as I talked about earlier with some of the growth, are really going to be stepped up. And that with the rates being so low, with a super accommodative Fed, and I think banks that are going to be willing to lend money, I think valuations in the market across the board will be able to remain elevated. And so if you do have a quality name, I still think that there's some great opportunities to make some money.
How long do you think that'll be sustained if, because it's right now, as you're saying, money's cheap, but, demand's not there. But when, if we do a V in a recovery in this, how long do you think those opportunities there where the cheap money's out there is really, when does that end up, stop?
Yeah. It's not going to be a straight shot. But I think what's happened here is kind of the only, when you had the Fed came in at the end of March and said that they would be buying BBB corporate bonds, right? And so you had a lot of corporate bonds that were down 20%, like the stocks were down 20%. The Fed just came in and said that they were going to buy them. They didn't even buy one bond, and they rallied back 20%. So I think a little bit of that has happened in the stock market, where they haven't said they're going to be buying stocks, but I think the implied here is that if things actually did get crazy weak, that you may have a central bank of the United States ready, willing, and able to buy actual stocks. Now that's kind of I think that's kind of your downside. I think there's going to be volatility, but I think what's going to happen here, and I think this is the key, is that in the stock market, the winners are going to stay concentrated. Meaning you got these growth guys now that have done great, and that's going. But there's a lot of stocks that we own, a lot of value stocks that have not done as well as that, which are still going to do great in this current environment, right? So I think there's just less and less stocks that are going to do well, and I think we're in a lot of them. And so there'll be opportunities to make returns. Does that help?
Yes, thank you. Any questions from the group? I have one other question on an aside that you mentioned at the beginning, that all your folks are working from home, but things are working out for you. And the folks that we have, we're in a situation here, being utility, we have a lot of frontline people, and they certainly have to come in. But but we have a large amount of people that are home also, and I haven't seen, at least from our perspective here, where productivity dropped off. You were talking about the recovery of the oil industry and things when cars start moving around, but then we're also in the new normal. There might not be that many cars moving around. Is your company have an intention of coming back to the office, or are you getting pushback?
Yes. No, well, a lot of it's dictated by the phased approach by the governor of Massachusetts, but we have a target date of September 1. And the reason why we did that, Mr. Chairman, was out of the 50 people or so, I'd say, Will, correct me if I'm wrong, I'd say close to 80% of the firm that's going into our office in Boston is using mass transit. That's one. Secondly, a fair amount of the 80% have young children. And so we figured, now would be a good time, considering the phased reopening of Massachusetts, that this would give working parents time to figure out their plan. What are we going to do with our kids? And is it safe to be on mass transit again? So, and I think, those questions will be answered in short order as they open up more aspects of the Massachusetts economy. But we felt as though it would probably be good just to give everybody additional time to figure out their plans are going into like the next school year.
Yeah, that's the key thing, is like having people that have children. There's just no way they could come in because there's no daycare. But I'll say, because our business is mostly conducted on the phone and conducted on the internet, I would say productivity in some businesses has probably actually gone up. I know I'm on like 24/7 now. I mean, there's no getting to work and going to lunch and going on a plane anymore. This is connected 24/7. I mean, I think we're fortunate in our business that we can do that. Now, what we're missing, and we've made up a little bit on Zoom, is that we are kind of missing talking to managements face to face. I mean, I know I travel a lot too, and seeing clients and seeing managements and really kind of seeing your peers and going to conferences. I think that's the unknown. But what I've seen is that we've all put together more kind of, talk groups and chat groups and, Zoom groups. So there's now a lot of conferences that we used to go to in person that are now on Zoom or on, WebEx. And I think what's interesting is that when you're on Zoom or WebEx at a conference, you're actually focused. You're not socializing as much and going around. So yeah, I think we're going to make do. But I think in the end, we may need some less office space than we do now. But I'm actually really impressed by our people and what they've done during this time.
Well, I didn't think your productivity dropped off. That was my point, was it's doing so well, and it's doing here is your opportunities going forward. What are things that are driven by people going to work when they may not be, and not just your company's a microcosm because you can do everything on a computer and on a phone.
We're very fortunate in that. Fortunate up front.
Very, very fortunate. Yeah, it is right. It's gonna be tough now to think, leadership positions. I mean, I think the human contact has to come back, right? You really need to have that at some point, but we'll make it work.
Okay. Any other questions for the group?
Yeah, I do. This is Larry.
Oh, I'm sorry. Go ahead, Larry.
And this is either Will or John, doesn't matter. for me, I see that the stock market has really made an amazing comeback, but the economy is still, to me, in the dump. What's your vision for the next 6 to 12 months? I mean, the stock market, can it continue to do what it's doing with so much unemployment? And as soon as these people reach this time period on the PPP, they'll probably start laying off employees, firing employees. How do you see the stock market continuing with the economy being so bad?
Yeah, if I could answer that, yeah, I think you hit on a good point there. What the stock market does, the stock market doesn't trade on the present, right? If we were trying to trade the market on what we thought the economy was the last 2 months, you would have sold everything. But I think what there is that it's two things. There is an intrinsic value for all these companies. You look out, but a lot, you're right, a lot has been discounted in a lot of these prices. I think going back to what we were talking earlier, that's why the market's becoming more and more concentrated in the winners. And so it's driving the indexes. Yeah, no, it's got ahead of itself, not ahead of itself. It has got ahead of itself. And the question is by how much? But I think the key point though is that you had to stick with it, right? You had this massive pullback. You had to stick with it. You had to buy quality, sell stuff that wasn't going to work. And at this point, trim around the edges, but I think there's just nothing else to do except kind of stick with it, because it is going to turn. And I think what we're every day striving for, is trying to figure out, how are companies going to operate in this new environment? Will it be a cost savings, right? Some companies that be able to cut enough costs to still make a lot of money. My kind of worry, it's kind of a positive and a negative, is that I think companies are finding out they can do the work with less people. If you look at some of these big consumer good companies that have 25 or 30,000 employees, they may find out they could do it with 10,000 less. So that's great for the company. I don't think that's great for overall society. But I think those are the things that we're really trying to dive into now. Is that looking out 1 year, 2 year, 3 years, things are definitely going to be different. And we just got to hopefully we can figure it out.
Okay.
Yeah, the only thing I'll add to that, Larry, is that what drives the U.S. economy, and that's the consumer. And if roughly you've got 5 states right now that still have what would be deemed or called a draconian lockdown in terms of New York, New Jersey, Pennsylvania, Illinois, California. They make up 1/3 of our GDP. There just has to be tremendous pent-up demand there. And as Will points out, some of the changes that will occur, inevitably you're going to have some new innovative folks that will be looking for people. And I think that's going to drive probably some of the change and fundamental change and transformation in the labor markets. But it's also going to translate into probably some very good profits for some very innovative companies.
Yeah, quick follow-up question to that, if I may. And again, I don't want to labor this too long, but might we be setting ourselves up for a bit of a inventory cycle here? I confess we continue to do our part to support the economy. A lot of my orders on Amazon, or my wife's orders on Amazon, there's no inventory. I go into my favorite store, which happens to be West Marine. The shelves are bare. Several of my friends have medium-sized businesses, I would call it, in retail, and they are rapidly getting out of inventory and very concerned about how they're going to restock their shelves. Obviously, the supply issues, China's providing a lot of that, but are we possibly setting ourselves up for a classic inventory drawdown period where we get a surprise to the upside as people go back to the manufacturing plants, we start importing again, and retailers have to restock the shelves?
Yeah, if I can answer that just in a couple sentences. Yeah, I think what that's going to set up with is stuff that's out of stock or in a short short supply. If they have pricing, it'll be incredibly, incredibly positive, right? If we can get, I think that's what everybody wants. Not just the owners of the businesses, but also the Fed. They want some pricing back in the economy, because at this point there is wide swaths of the economy that don't have pricing. Probably like around you. I mean, the hotel business, has gone through a 10-year run here where they've been able to raise on price every year. That's probably not going to happen. But yeah, I think in those type of businesses that you're talking about, if they have consumer demand, which is going to drive it, and they have some pricing power, and I think long term, if we can get manufacturing back into the U.S., which is started in past years, if we can get some of that manufacturing back into the U.S., it'll be incredibly positive. And even if it costs more, right? I think even if manufacturing costs more, I think there's ways that the government can work with the manufacturers, mostly through tax incentives, to bring this stuff back and then bring down that cost differential that has driven so much of the manufacturing out of the U.S. the last 30 years.
And low energy prices puts us a little bit competitive, even though the wages are, thanks to us.
Yeah.
Thanks to the wages. Of course, there's a giant differential in wages, labor costs between us and countries, but we do have really low costs in energy now that puts us somewhat competitive to the rest of the world now.
Yeah, absolutely. And I think, and the other side is taxes. And then if the government really takes it upon themselves, and the banks take it upon themselves to make the loans, I think we can make it work.
Well, any other question on this? I see there's a couple of pages left. If we went through those pages without seeing them, or hit some more points here?
I think, Mr. Chairman, those pages pretty much summarize not only the activity, but the holdings, and what you're looking at there, the remaining pages, those are just the characteristics of the portfolio in terms of top 10 holdings. And of course, in case you want to see our Sunday church pictures, you can have a look at our biographies there as well.
I have a question for John, if I can. This is Scott.
Yeah, Scott, sure.
We have a proposed fee change, John. Could you explain that fee change and that addendum, and then give me a chance to kind of respond or give you my 2 cents, please?
Sure, absolutely. So this in effect was what we did was we looked at, it was a legacy issue we had to address where we wanted to make sure we had a unified fee structure in place for all of our ANCO clients that are subscribed to our all cap value strategy. And so what we came up with was a structure that was fair and equitable for all of we have about roughly 19 mutual clients with ANCO. And we felt as though by making sure that we had this structure in place, it would be a blended fee that would be the same for everybody. And that's how we came up with the existing fee structure was 75 basis points on the first 3 million and 50 on the excess. And that was agreed to probably, well, again, it was set in place well over 8 to 10 plus years ago. And then after I did a fairly extensive study of other all cap value manager fees. In fact, not only did I poll and gather some information from ANCO, but also from some of their peers. And that's how we came up with the new proposed fee structure of 60 basis points in the first 8 and then 50 basis points thereafter. And we've been told by many other firms out there that the blended rate that we came up with was quote unquote more than competitive. And then what this represented for your folks was, based upon your mandate, was a 0.2 basis point increase or a $500 on an annualized basis. But again, the end goal here, Scott, was just to make sure it was fair and equitable for all.
And I suspect, certainly in the contracts that I do, you have a most favored nation clause that probably you might be trying to equalize everybody so you don't run afoul of that provision.
Exactly.
If the board's okay with this, I'm okay with it. I don't know if Dave has anything to say about the fee itself, but I would, however, and John, you should already know about this because I made the same suggestion in Palmetto, that if we need to do an addendum to your contract, And we have some Florida laws that have been adopted since we originally entered into your contract that requires us to put some additional provisions into the contracts. One of them has to do with public records and what have you. And you should have already gotten that for Palmetto, John, so you know what I'm talking about. But
In fact, cybersecurity too, Scott.
yes, cybersecurity.
Yes.
Yeah.
Yes, and we, just to give you an update on that, we are getting a policy addendum to our current E&O and fiduciary policy that will cover cybersecurity.
Okay, so I think maybe you're telling me you're okay with the addendum that I did.
Yes, absolutely.
Okay, so if the board is okay with the additional fee, then maybe you could do a motion to approve the change in the fee structure and authorize me to do an addendum to their contract to reflect the changes.
Do I have a motion to reflect Scott's comments?
So moved.
I have a motion and I have a second.
Second?
Susan,
I guess
second.
others going to die for lack of a second. I don't know, Scott.
Thought so too.
I'd ready to give a second. From
Get it.
We have
Wake people up when we start to talk.
We're all struggling to get off of the off mute. I realize what's going on. So, all in favor? Any discussion? All in favor, say aye.
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 Is anyone opposed? And the motion carries.
All right, so I'll get that out to you as well, John. It'll look the same as the one that we did before, okay?
Great, Scott. Thank you so much.
Okay. Thank you.
Thanks, Scott. So any other questions for Anchor? Any other comments, Anchor, do you need to give to us?
No other comments from myself, other than the fact we look forward to seeing you back in your offices next time. And as things do start to open up for more, and then you do find yourself traveling to Boston, we would welcome an opportunity to be your host. I think there's nothing better than being in Boston in the fall. So
Okay, we'll keep that in mind. Maybe that'd be our field trip. We'll think about
that'd
it.
be great.
Yes, sir. I like it.
All right, any other questions? Thank you all so very much, and we'll move on to the next agenda item. And that would be Co.
All right, good afternoon, everyone. And I too also look forward to seeing everyone in person rather than VTC here, although this has been a very good way to get through this. Quick operational question, Keisha, can I take possession of the screen, or am I locked out?
Sure, give me 1 second.
I think if you get out, Keisha, he can get in. Yeah, there you go.
Can you see me now? My screen? I've got my
Yes,
laptop up. Okay.
the investment policy is on.
Yeah, I've learned to shut off my email so I don't get 100 pop-ups in the middle of these conference calls here. Yeah, so my agenda today, I wanted to first start with an update, more current relevant information through April. Obviously, we need to go through the March report, and then I had the administrative item up you see before you. We went through the investment policy statement, and we just had a couple of minor changes to go through with you on that. So I forwarded a couple of perspective slides that I'd like to go through. And again, I don't want to spend too much time on this for efficiency here, but I think it's very important to have a good perspective on exactly what transpired in March before we go through the actual investment numbers. This first chart here is a chart that shows the S&P 500 total return. And we go back to the three previous crisis periods here. And the x-axis here is actually the number of days. So if I go back to the tech wreck in 2000, the total drawdown was 47%. And that took actually 529 trading days. Financial crisis in 2008 was a very painful drawdown all in of 55.25%. And that took 355 trading days. Fast forward, we go through the coronavirus impact, which was February, mostly February, March. And we hope what is the total drawdown for that experience was 33.79%. And amazingly, that was done in 23 trading days. The market volatility, the ferocity of the moves was just incredible. Lots of black box trading, computer trading, heavy influence from index funds, ETF buying and selling. We had a couple of manager transitions we were trying to get done during this time period, and working with the transition manager, we said, we decided, look, let's just sit back. We need to get through this volatility before we can even attempt to transit anything in the equity markets. As everyone's aware, since 2008, the SEC implemented limit up, limit down rules to try and mitigate some of the intraday trading volatility, and those limits were hammered many times, both on the upside and the downside. But I wanted to just elaborate a little bit on. I think Bill had made the comment. The most important thing to happen to your investment portfolio occurred actually in mid-March, and equity markets were tanking, doing their thing, and but what people didn't realize was over in the credit markets, we were quickly headed down the path of the Lehman Brothers implosion back in 2008. We were rapidly headed for a liquidity crisis in credit markets, and as everyone knows, credit drives a capitalist economy, and the Fed recognized this and came in very aggressively with the playbook established from 2008 and 9, and provided two very important support programs that Bill mentioned, and the investment grade bonds that you're participating in were indirectly supported by this Fed program. And as they indicated, the Fed did not necessarily, Treasury did not necessarily buy any securities, but the fact that they came in here with these two support programs really helped to provide a floor to the bond market. And no coincidence, around that time, that's when the equity markets reverse course. Obviously, since then, it's been an open checkbook, and the Fed, Treasury, and Congress have pledged all possible resources to bridge corporate and corporate America and individuals to help get us through this light switch shutdown in the economy. The second chart, I just wanted to quickly share. This is our quilt chart or periodic chart. And what this chart does, it ranks the best performing publicly traded investment areas and down to the worst. So if you look at what transpired in the March quarter, and this is on a calendar quarter, the Bloomberg Barclays US Ag was up 3.1%. We go down to the next asset class, which was publicly traded equities. They squeaked out a positive 0.7%. And then it goes downhill from there. Every single publicly traded asset class or major stylistic asset class had really terrible performance. And I was commenting earlier because look at the worst three performers were the Russell 1000 Value Index down 26%, and the Russell 2000 Small Cap Value Index down almost 36%. So again, kudos to the anchor team there for maneuvering as well as they did through a very troubled period of time. The other big surprise here is actually in the Poultry returns that were earned by the bond market. We should be asking ourselves the question, hey, why were bonds only up 3.1% during this period of time? And the reason was the crisis that was evolving in the bond markets. Corporate bonds, if you look at corporate bonds kind of on an equalized basis relative to the other areas of the bond market, corporate bonds themselves were actually declined 10% during the March quarter, and underperforming treasuries by 10%. That's huge, hugely disparate returns. So we didn't even get that much support coming out of the bond market portfolios. So very, very unique, very interesting, very volatile period of time. So let's go to the most current updated report here. And I'm going to take you through numbers ending April. Mary gave us an encouraging update for May. We haven't been able to pull all that data yet, but we should be looking at markedly better results, once we get all the May numbers in so far to date. But through April 30th, the fund for the month was up 9.19%. And fortunately, our policy index was up about 8%. So we picked up 1.23% relative to our self-imposed policy. Now, this is important because on a fiscal year to date, that means the fund is really just down 1.3%. So that's the reason for my optimism to Larry's earlier question or concern. Are we actually have any potential of breaking even this year? And I would argue, maybe through May, that looking at the total fund all in, we may actually be there today. We did leave percent of negative return on the table there. Total fund policy is almost flat. So let's talk about what happened there. If we quick look at the asset allocation, if you recall, at our last meeting, we and most other managers, I believe, were reasonably optimistic that the prospects for economic growth, at least in the U.S., remain favorable, and it was a reasonably positive investment environment. So we all discussed leaving our equity overweight position, or domestic equity overweight position anyway, in place. So obviously during March, during the market downturn, being overweight equity was not helpful. So that was one of the detractors. Certainly that's helped us on the rebound here. And then the other detractor, as we go into the report, was that both Anchor, Wells, and to an extent T. Rowe, but mostly Wells Capital and Anchor, are all cap managers. So they did have some of that mid cap and some smaller cap representation in the portfolio. And again, as we discussed earlier, those were some of the areas that were hardest hit in here. So continuing through the April report then, if you look at total equity portfolio, we've recovered nicely. All in, our active management element here was a net value adder on a fiscal year to date, down 3% on equities versus 4% all in. Each of the managers, particularly Anchor, did pretty well. The Wells heritage as a growth manager, again, going back to that earlier point, look at this. The Russell 3000 value index is still down 13%, but look at the growth index. The Russell 3000 growth index is up 8%. Hugely disparate returns going on here, but that's why we're diversified. We can never call when that's going to happen, but we had been slowly taking some growth money off the shelf, unfortunately, in some of the rebalancings. But growth continues to be the dominant space to be. Also, the T. Rowe Price Blue Chip, our newer addition there to the portfolio, also outperforming marginally on a fiscal year-to-date basis. International equities, Euro-Pacific growth team, great job. You know, again, lots of singles and doubles, both for upside market and downside protection during this decline here. So they saved us 3.08% on a fiscal year to date in capital preservation. Going to the fixed income portion of the portfolio, Integrity Fixed Income is like many other bond managers. They do invest pretty heavily in corporate bonds, and corporate bonds were significant underperformers during the March quarter. However, Earle was able to earn back about 1% there on the month as the pricing of corporate bonds responded favorably to all the Fed support going on there. But on a fiscal year to date, you know, we left 2% on the table. So there's another little piece of the total fund underperformance. Surprisingly, or maybe not surprisingly, the Treasury Inflation Protection Securities portfolio, the reason we have this in here is not necessarily as a guard or an offset for inflation. We really had that in there is for that rainy day when everyone, you know, heads for treasuries. Fiscal year to date, almost up 5%. Again, because that is a treasury portfolio, so performing well there. PIMCO, Diversified Income Fund, fiscal year to date. This manager does invest in lower quality, and the returns, you know, reflect that. But again, making some inroads on the recovery side here. And while we're on the bond portfolio, I do want to point out that since you are an A or better, and we've had the discussion several times about potentially downgrading or allowing for BBB rated bonds, which are still investment grade. Because your portfolio was A or better, you actually fared much better than other portfolios that did allow for BBB bonds, because BBB bonds did deliver a very negative total return. And because of the high quality nature of this portfolio here, this is one of the few systems, I would argue, that actually did get some material help from the bond portion of the portfolio. So that worked when we wanted it to work. Last but not least here, Morgan Stanley Real Estate Fund. I don't have updated numbers, obviously, for April. So this is a March carry forward for that valuation. But basically through March anyway, fiscal year to date, 2.75%. And the manager continues to annualize, you know, right around 6.75% on a year-over-year basis, and continues to be one of the better performing funds. While I'm on here, and for the sake of efficiency, we have been in touch with all of the real estate managers and a lot of our private equity, private debt managers, which we don't have any of that investment in here, but real estate was not impacted, has not been impacted yet by COVID, at least as far as reporting through the March quarter. All of the managers, Morgan Stanley included, have aggressively gone in and identified those industries which are most vulnerable, and then went down the list and identified those tenants who are most vulnerable to the COVID shutdown. There's been a lot of renegotiation of leasing, waiving of interest payment, and as investors, they're doing their best to protect all of us. So a lot of that is going to be made up on the back end of the lease negotiation, maybe an extension, but they're doing everything in their power, to keep good tenants and to help good tenants, continue to stay in the properties. So this quarter and definitely next quarter, real estate managers are definitely suggesting this is when we're going to see the impact show up on real estate. So through the March quarter, real estate has done a great job for us. It's a lagger. It worked very, very well as a diversifier for us. So hopefully equities will continue the rebound here. So when real estate returns start to potentially approach, maybe flatline for a couple of quarters, we'll be making it up on the other end with our equity investments. Question?
Yeah, this is Larry. On talking about this real estate, I mean, I think this real estate is going to be affected for the next few years now, because you're going to have companies that are saying, heck, I can have 50% of my workforce work from home and still get the same thing done. These people are going to be going to smaller rental space. They're not going to be leasing 100 offices when they can use space that only needs 50. That's my belief.
Yeah, and that is a very, very important question, and arguably that is the second order question of the day. Looking forward, that each of the managers themselves, they've raised that question, and those prospects, what is the return going to be like, and is it going to be lasting? Now, in the case of Morgan Stanley or other quality managers, the leases are on a rolling schedule, and for sort of a bankruptcy, it's going to show up in a delayed manner as these lease rolls come up and space gets renegotiated. But you raise a very, very important point. And, the real estate managers, Morgan Stanley, that team, they are absolutely looking at this and how they can best position the investment there with possible adjustments to the allocations to office space. And, we've already talked, they've already been in to talk to us about what's going on at retail. So to your point, we may see a pretty significant migration in property type, more towards warehousing and that type of commercial property going forward. I think the other element here is, what happens. I don't think Morgan Stanley doesn't have any travel and leisure type, hotel type properties in there. But for those managers that do, certainly that's going to be another area that may definitely see a slower return, as we were talking about earlier. It may be a while before we have any more conferences to go to. So all of these things, the managers are looking at this and what the implications are, intermediate and longer term. Absolutely.
As a board, I think we might want to look and consider our allocation to real estate. I mean, it has performed outstanding for us over the past many years, but this is a new world effective now.
Yeah, now
they have better opportunities to allocate some of that capital. So that's just board members. You might want to, think about that a little, because there's a time to exit everything.
I agree with that, Larry, and from what I'm reading from what Dave's telling us is that they are making a study, and I think we could be asking him for a recommendation on it, whether we hold or fold. Probably if it's something that we need to have a special meeting if things really start deteriorating. But I think, is that what you're talking, is Dave, am I reading it right, that you're on top of this? And if a recommendation is needed, that this is a market, this is a sector that's not coming back for a long time, that we leave?
Yes, and we've already moved our real estate allocation back a notch. Remember, we did have a a much higher overweight previously, and as the cycle got long, and real estate valuations were arguably getting pretty full. We did move and went back to basically a no bet. We're right on policy target right now. However, we still it's still within our latitude to go to an underweight position. We would still be strong advocates of maintaining a core position in a fund like this. This is an excellent fund. Should weather downturns reasonably well. But again, I would agree that we need to leave that conversation open and see how things evolve. One technical issue that we are encountering right now, however, is during March, most of the real estate managers shut the door to redemptions, and I need to confirm, but I believe the Morgan Stanley fund also has temporarily closed the door for investor redemptions. Again, given the uncertainty out there, their objective is to protect investors. They were concerned that we were going to have another 2008, 2009, where everyone had to rebalance, right? And they needed to pull money out of real estate to put it back into equities, because at that time, equities were down probably below minimum policy targets in that 55% market decline there. But either way, given the uncertainty, the real estate managers have closed the door. So we may not necessarily be able to make an adjustment. So it's fortunate that we've already moved it back to the policy target. But absolutely, let's keep that discussion on the radar screen. And yes, we are in close contact with the management teams from Morgan Stanley here, and to see what's evolving.
Are we in the drip, Dave?
I believe we are. So that's another way that we can not reduce our principal investment, but we can be taking money out of the real estate fund as the dividend distributions come out quarterly, and reallocating those monies elsewhere. So that is one way that we can manage on the margin the real estate allocation there. I will confirm that, and actually for this conversation, if it's agreeable to the board, if we are on the DRIP program, I think this would certainly be an appropriate time, given the very valid concerns that Larry raised, that if we are in the DRIP program, that we uncheck that box and we take those distributions as they come out and use those monies to reallocate them elsewhere in the portfolio. So if the board's okay with that, I'll be happy to follow up on that and make that change if that's the case.
All the trustees understand what we're talking about with the DRIP?
Yeah.
Basically, we're reinvesting the money that we make in that fund, and we're reinvesting it in the fund. Now we're talking about, instead of reinvesting it, we're taking that money out. So we won't be putting more money in, so to speak, that's represented by our dividends and other distributions.
Well, board, what do you feel? Do you want to take, while we're getting dividends, that we take what we make and reallocate? Is that, if we're able to do that, is that the pleasure of the board? Do you want more discussion?
I would agree with that. And I would also ask, agreeing with what you had said earlier, Dave, don't wait for another meeting. Just keep us posted on what's going on and what our options are. Because we can have a special meeting if we need to take additional action.
Right, absolutely. And looking at the cash flow, it looks like we are receiving the distribution, but I just want to make sure that's not an accounting
No, we
entry.
do. We receive distribution quarterly.
Okay, so then we don't need to make any change. So, you know, we're already receiving the distributions.
Oh, okay.
No,
so
but
we're not needing
reinvested.
to-
They're
I'll just
automatically
confirm that.
reinvested. They are automatically reinvested into the real estate fund.
So we're in the drip and we want to get out of the drip.
Exactly.
So
Right.
we need a motion to that effect if that's what the board wants to do.
So moved.
So I have a motion to get out of the drip, and the understanding of that is that means we're reinvesting our dividends that we receive. And what we're asking to do by that motion is not reinvest into there, but disperse it in other parts of our portfolio. Do you want, is that going to be a second question, or do you want to drill down on that, where you want that to go, Larry?
No, because it's not going to be enough to be concerned about where it goes at the moment. But at least it'll stop our from increasing in real estate.
No, we'll have time for that.
Plenty of time.
And in fact, we can use that for distributions, quarterly distributions.
Yes, it can help with fees.
Okay, do we have a second to the motion then that we discontinue the drip program?
I second the
Second.
motion to discontinue the drip.
Okay, a couple seconds there. Then any other discussion on this? All in favor, say aye.
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 All opposed, say no. And that passes unanimously.
Okay, we'll follow up on that and make sure that gets done. While we're in the most current data, that brings us to the next issue. We are back up to a pretty good overweight given the recent equity market appreciation. So we're 5.7% overweight in domestic equity, about at policy target. If we split hairs here and get into decimals, drop down to the table there. There's our targets, 65% in equity all in. And as you can see, we're approaching, actually through today, we are probably at our 70% equity limit. I'm a little bit hesitant to recommend to any client to roll back the domestic equity allocation in here. But for this particular circumstance, we are pushing policy limits. And if we look at the actual investment policy statement here, we do have an upside limit of 70% to equities. So if it's agreeable to the board, I'd like to recommend a partial rebalancing. And that would basically be to take, I'm going to suggest, let's take 3% off the table. That still leaves the overweight in place. And, this may sound a little bit counterintuitive, but that 3% then is going to need to go into the domestic fixed income, and that gets the portfolio allocation much more in line with the policy targets, but still maintaining a modest overweight to domestic equities. So this action is really a compliance-driven necessity that we do some kind of rebalancing here to pull that back so we're not in violation of our equity investment limit.
Board, we faced this issue, I don't know, 6-9 months ago. And I still say we need to take a look at our policy because it just simply does not make sense for us to reduce our equity allocation at this moment when we can simply increase our policy.
No, actually, the ordinance or the resolution for our plan has a 70% limit on equities. So the board really doesn't have authority to change that 70%.
We can't change that.
No, sir, unless we go back to KUA to increase that 70% through a change in the resolution.
Well, being above 70% would have been good right now, but not so good last month. So I'm not too upset about that.
Having it above 70 doesn't mean you're always going to be above it, Larry, but it does allow us opportunities like this to not have to take it out of something that's potentially.
But I'm for that because we're between now and the next time that we meet to rebalance the way stock market's going, it'll take us in that momentary out of compliance. I'm seeing this was happening to us right now, and it's probably going to get there again. So I think by what Dave suggested, we can stay in compliance and still the portfolio is going to grow heavy on that side. In fact, exceed into our next meeting when we do rebalance. So I think we still have the opportunity not to leave a lot of stuff on the table.
Yeah, and per Larry, per your concerns, I'm happy to modify my recommendation from a 3% to 2%. But I do recommend that we provide ourselves a little bit of room in here to make sure that we are in compliance.
What's
So,
our current allocation, Dave? Or equity allocation, what is that? 55 and 14?
We're at 55. Let me make that a little bit bigger there. 55.7 and 14.7.
69. Boy, we're just barely over it, aren't we? Yeah.
Right. But again, through I think May,
this is March, right?
Yeah, May. I think equities are up 4%.
Yeah.
Additional just on the month. So and I know corporate bonds have performed very well also. So we're likely maybe 2% over policy, but that's between our official measurement periods.
Well, we have a couple options here for the rebalance, 2 or 3%. Is there discussion from the board on a preference to stay in compliance?
Yeah, if we're going to do anything, I'd rather 2 than 3.
And I would rather 2 than 3, but again, what we're looking at right now, Dave, you're saying what I'm looking at on this piece of paper, 1% would get us in compliance?
Yes, as of the April print, asset print, yeah.
So are we basing our policy on what we're looking at right now or what has happened since what we're looking at?
Both.
Most recent.
Okay, then the 2% I would be in favor of.
Somebody want to make a motion? Probably not Larry.
You know I don't.
Jason, Barbara, you guys have an opinion on this?
I'm good with 2%.
Barbara?
Sorry, I agree with Jason.
Okay, I can support that. So I think that puts us where we need to. So now if someone gives us, it sounds like it's going to be an easy vote. So if somebody would like to make a motion that we take 2% and reallocate, I'm open for that motion.
Where are we taking it from, Dave? I know domestic equity, but which funds?
Yeah, so I've turned to the page which shows our domestic equity allocation here. If we look at, make it a little bit larger. You can see our value manager anchor is at right around 25 million, and I'm sorry, that says of 10-1. I have to shrink it up. So we have anchor as of April 30th at 22.9, so 23 million, and the growth side of our portfolio is comprised of Wells and T. Rowe Price, and that's at 31. For previous discussions, we had been encouraging slowly starting to rebalance that growth overweight. But again, growth stocks continue to be very persistent here as the market leaders. The cleanest and easiest way and no cost way to complete this rebalancing would actually be to pull the money from the newer manager of the T. Rowe Price Blue Chip Growth Fund. That is a institutional share class mutual fund. So that's a one-day trade with no transaction costs. That would then continue our previous efforts to kind of try to equalize the allocation between value stocks and growth stocks. So I would suggest from a cost standpoint that we pull the 2% from the T. Rowe Price Blue Chip Growth Mutual Fund.
All right, I certainly agree with that. Anyone else have any disagreement or with that?
So what is that, about $2 million, Dave? Is that what we're talking about?
Yes, right around just under 2, I think.
Yeah, okay, that would be 2%. So 2% from T. Rowe Price into Integrity Fixed Income, is that what we're saying?
Correct.
Wow.
Do we have a motion to do that?
Yeah, I'll make a motion to move 2% from the T. Rowe Price Blue Chip Growth Fund into the Integrity Fixed Income Fund.
Do we have a motion? Do we have a second?
I'll second it to balance.
Okay, we have a motion second, and it's been put onto the, and it's been stated in the motion. If you agree, Jason, that that's the motion with the balance wording, you can shake your head. Yes. Okay, I see now. Okay. So the motion says that we're rebalancing, and the method that we're doing it is taking $2 million from T. Rowe Price and taking it down to Integrity Fixed Income. Any further discussion? All in favor, say aye. Aye. Anybody, any opposed, say no. And motion carries.
Okay, so we'll also get that done. So trying to keep us moving here. Let me just pull up the March report. We've really discussed everything that transpired in here. So let me just hop to the bottom line. If you look at, what am I on? Page 20 of the actual report. That's going the wrong way.
Can you make it smaller, please?
That's too small, Dave.
Not that I want to make this number any larger.
I'm starting to get suspicious. This report keeps shrinking it down.
Total fund for the quarter down 14.7%. Very painful. We did leave money on the table. Our benchmark index, as I talked about earlier, was down, right around 13%. The peer group ranking that resulted in that for that one quarter, not good, 75th percentile. So if you look at the median return of the average public system in our nationwide database, everybody suffered. The median return was a negative 13.12. We should have come in right on that number with our allocation, but unfortunately, because of the allocation, the overweight primarily to equity, we came in a little bit under that. On a fiscal year to date through March, we were not in good position, 9.6% in the hole. And, fortunately, since this was kind of an average experience or slightly below average experience, as we look at our 3-year average, it really didn't impact our peer group ranking. We still stayed in the top upper 12th percentile, and the 5-year number, we stayed in the upper 11th percentile for other systems. So it wasn't the best quarter by any stretch of the imagination. A little bit frustrating there, but the degree of underperformance didn't hinder or hurt our longer term averages all that much in here. And it looks like on the rebound, as I said, through May, we're probably going to be closing up most of that gap. So we should be back to the rankings and performance, that we would prefer to see. So unless there's any questions on the March report, I'm just going to leave it at that.
Hey, Dave, this is not a question on the report, but I don't see the agenda, so I don't know if you were going to speak later on. But we had asked you to investigate a manager.
I'm sorry, could you repeat that question?
As a board, we had asked you to investigate a manager and give us some feedback. Have you looked into that manager?
Okay, and I think we reported back at the last meeting on those.
No. At the last meeting is when we had asked you to look into them, actually.
Okay, so let me check my notes because I
You have
remember
that
doing.
information?
Which manager were we looking at, Larry? Can you
You know, it
remind
was the one that I heard at our last conference. They did the growth, dividend paying growth stocks.
Yeah, I thought we had looked at them when we did
We haven't heard anything back. Keisha, are you there?
Let me do this. Let me go back and check my notes. And if I'm remiss and owe you a response, I apologize, and I'll get that turned out.
Okay, Keisha, what were you saying?
No, I was just confirming what you were saying. It was in the last meeting that we requested that. So
Yeah.
it would have been this meeting, the first chance you would have had to come back to us with it. So.
Okay. Then I apologize on that one. I remember some interactions there. I'm going to go back and pull up my notes and see what came out of my research group from that inquiry. So I will send you a response, I guess appropriately through Keisha, right?
Yeah.
Intermeeting.
Thank you.
Okay. So the last thing I had on my agenda today was the investment policy statement. Cover this pretty quickly. We went through and reviewed your standing policy. So the amendment or change document here is really just addressing two things. Index nomenclature. As some of you are probably aware, the Merrill Lynch index series has been taken over a couple of times. So the current naming is the Bloomberg Barclays. So all this redlining in here for benchmarks for those indexes just to get us updated to the current index nomenclature. On real estate, again, another index nomenclature issue. We just want to be clear that in our real estate benchmarking for Morgan Stanley fund, we are using the equal weight. So we just want to have that in writing. Again, minor issues here, but we want to make sure everything's right. And then those carry forward, obviously, index naming again in the target allocation policy performance that we use in the book. So we got to carry that into those. And then the second item is that, as we discussed, I think at the last meeting, we're striking the actual and incorrect actuarial rate of return number here, the 8%, and we're just leaving that blank, no reference there. So it will read exceed the actuarial earnings assumption and provide inflation protection. And again, I think we had discussed this at the last meeting. So two changes to the policy, to the standing policy. One is proper index naming, and the second is removal of the 8% or the actual statement of the rate of return assumption number.
Scott, do you have any issue with those things? Are we fine?
I don't have any issues with it. Just a reminder, though, we have a number of addendums or addenda that we have with the various managers who have separate accounts, and we would need to get those acknowledgements or those addendas re-signed to encompass the new date on this main policy. I just want to make sure that gets done as well.
While we're on the policy again, guys, just for the board, how long have we had this 70% restriction in place? Scott, do you know how long that's been? When was that?
I mean, that's a pretty aggressive limitation, quite frankly. But I can't tell you when we had it in there, but I'm thinking it's been in there for quite a while.
Yeah, it's still, guys, I think I'd like for you guys to at least keep it in the back of your mind that this may be the time to go and ask the board for an increase in that limit, because we're penalizing a sector because they're doing well. And we are, you guys talking about break even, this negative that we've had since January, it's going to take probably years to make that up. It's not going to just happen. And you're never going to make that up by investing more money in fixed income. We need to be aggressive when the opportunities make sense. And this, to me, is a perfect time to be in equities, not to come out of it. So just think about it. Even if we ask for 75%, when it doesn't justify it, we don't allocate it that way.
Do you think that would be well received by the KUA board, Larry?
I
Hell
don't
no.
know.
We're
That's
under
what-
fire right now. We just had a member of management from our finance team say in a meeting that our plan is underfunded. A member of management said, your plan is underfunded, which it was corrected. The statement was corrected because it was wrong. But no, this would be, I think we need to get this thing back on good footing so that when we end this year, to see our rolling average keeps us where we're not asking for an increase from the board to fund this thing. I don't think this is a real good time to be coming to the board with this. And believe me, I'm in a better standing than the rest of you, because I'm close. I could sign out of this thing any day and be protected from any changes on there. But I think what we're hearing right now, it'd be a bad time to see something on the board like this. I'd like this to, my opinion, and I've been for a while. You can call Joe; he'd tell you the same thing. That we get past this and see where we're at on our smoothing, and see if we're up or down, and then we consider approaching the board or something like that.
But we're definitely not going to be up. There's just mathematically.
Well, you still have smoothing. You still have smoothing is what we look at is what we do. We're not doing it a single year.
Yeah,
So
I think you do have some gains on the shelf. I think you're on the 5-year smooth, right? So we're recognizing 20% per year on some of the gains.
Is it 5 or 7 year?
I think it's 4 years.
4 year?
It's a 4-year smooth. Yeah.
So 25% of the gain.
So, I mean, I'm one guy's opinion. Like I said, I've been on this thing for a while though, and I know that I've seen, I was the most aggressive one on the board before. I've seen the ones around me would be afraid to go and just say we had a discussion. We sweat it out when we go to the board just to put mandatory language changes in there. And right now, our board's looking at numbers pretty tight because I mean they need to. We don't know what our collections are going to be. We're selling power, but we don't know who all is going to pay for it for a year or so. So
Everyone.
Thank you, Susan.
So does anybody else on the board have the appetite to, that we would approach the board and change our limits? Which, by the way, you saw that we were in the lower percentile to 75% because we were heavy. So I could imagine we've been heavier. But
Just something for you guys to think about. That's something we're going to get close to where we want to be, is to have more in equities, not less.
To both Larrys, the Larry squared.
Yeah.
I agree with you, Larry Webb. It hurts to be taking stuff out of there and being limited at this point in time. But I agree with the other Larry that I don't think it's a good time to take anything to the board.
I'll acquiesce to that. You guys know timing is everything, so I'm fine with that. Just keep it in your head.
Oh, of course. Thank you for,
That's all I'm saying.
yep.
Oh, and Larry, I'd like to thank you for stepping off the course for a minute. I see you have your Underperformers shirt on.
Hey, yeah, man.
I mean, if you need to take a break to go out there and putt, I'll just let me know.
I'm a member over there, to represent.
Any other discussion on this? Do we need a vote to accept the changes? Do I have a motion to accept the changes on this?
Yes, the revised investment policy statement.
So moved.
Do I have a second?
Second.
Second.
Do I have a motion and a second? Any further discussion? All in favor, say aye.
Aye.
Opposed, say no. And motion carries.
Okay,
Okay,
Keisha,
we'll get
remember that once the investment policy gets fully signed, including all the addenda, then you have to distribute it to the actuary and to the state and to KUA itself. And we have a pension letter number 3 that you can use to do that distribution. And send it to me too, please.
Yes, sir.
Okay, thanks.
Got it.
So we'll, as a matter of procedure, then as Scott described, Keisha, I guess as soon as we receive the executed clean copy file that I sent you, we'll start helping with that circulation, and we'll get it around to the managers. I know John's still on the call, so you'll be receiving this policy for your signature. We don't obviously there will be no changes to any of the manager addendums, just a change to the reference to the policy to this date. That's all I have.
Sounds good.
Thank you.
Looking forward to it.
Any other questions for Dave? All right, thank you very much, Dave. Appreciate the report.
Thanks, everyone.
And brings us to our next thing behind Dave and other stuff on the screen. Keisha, can you you got the sharing back? Did Dave give you the thing back?
It's
yet?
me.
Okay. Yes, hear the attorney.
There we
Scott.
go. Okay, I got just a few things today. First of all, a reminder for all the trustees, the financial disclosure forms, you may have already gotten those in the mail, but remember those have to be filed by July the 1st. And as I always say every year, I will check online before the next meeting and embarrass anybody who hasn't filed their form. So please be sure to fill out that form and send it in. And what we're trying to avoid, of course, is anybody paying any fines.
Have any of you guys received the form?
Yes, my form is filed. And I got it in the mail 2 days ago.
Where'd you get it in the mail at, Larry? KUA?
No, I got it at my house. I get it from the election, Board of Elections.
That's where it's supposed to come from.
Yeah, I got it
You
at
can
my
go
house.
online and just do it, file.
I don't think I have one.
You can go to the Commission on Ethics website on myflorida.com. And you can actually, I think you can fill it in online, but you can't file it online. But you can fill it in and then.
Send everybody a copy.
I beg pardon?
I'll send the trustees a copy of it.
Okay, that'd be great.
I appreciate that, Keisha.
That'd be good. That takes care of it. Okay, next item. At the last meeting, I talked to you about some pending legislation in the Florida legislature that would have required some additional training for the trustees. That bill didn't pass. So essentially, we don't have any requirements resulting from the last legislative session that we need to deal with. All right. I do have, we are involved with, and I guess I think we've already sent to Keisha a set of updated administrative forms. The reason for the updated administrative forms is that the Florida legislature did make a change to the notary public law, not pension law, but notary public law, not in this last session, but the session before. And essentially what they did was they added a provision that allows for what they call remote notarizations. And they actually have this in many states around the country. What it means is that a notary can be sitting, at his desk in Tampa, and he can notarize a document that's being signed in Tallahassee. How do they do that? What they're required to have is a means to see and record the notarization that they're witnessing, kind of like what we're doing here today. So if the notary has that capability and can keep a video of that notarization, the notary also has to have additional insurance and has to do some additional training in order to do this remote notarization. But if they do that, remote notarization is now legal. Why is that important to us? We have these administrative forms that we use to administer the plan. Application for retirement, application for disability retirement, beneficiary form, rollovers, you name it, we've got a form for it. And a lot of those forms have a notarization certificate on them, if it's an affidavit or if it's an acknowledgement. And so when they made this change to the law, adding this remote notarization, they actually changed the notarization certificate to add this option. And so that's now law. So we had to go through all of our forms and add that possibility of remote notarization. We took this opportunity to go through all of the forms, and we took care of some housekeeping changes that made my partner's name was on a couple of the forms. We also did some other housekeeping changes as well. We made the beneficiary lines a little longer because we had some comments about that. So little things like that. So we updated all the forms. We sent the new forms to Keisha. We suggested that she throw away the old ones, substitute the new ones, and we're good to go going forward. And I think that's already been done. Any questions about that? You might think, why is he telling us all this? I just wanted, if you see it on a bill, I wanted you to know what it was. So.
Okay, so anybody have any questions on Scott? I'm trying to think of the word, justifying his billing.
That's not the way I would have said it. But
I'm sorry, maybe I misread how you.
In essence, that's what it is. All right. Next item. I wanted you to know that currently we have a provision in our plan that meets the requirements of the Internal Revenue Code with regard to the reemployment of retirees. In other words, if you have somebody that retires under normal retirement and they come back to work, if they come back to work, they would be back in the plan. And the question is, can they continue to draw their benefit? And if so, what kind of ramifications are there? Currently, we don't allow anyone to draw their benefit unless they're at least age 62. And the reason for that is if you're less than age 62, you have a 10% penalty that you likely have to pay because you're drawing the benefit earlier than age 62. The IRS or the feds have amended the Internal Revenue Code effective October 1st of 2020 to reduce that age from 62 to 59 and a half. So in other words, we could allow somebody who's at least 59 and a half to draw a salary and also draw a normal retirement benefit without a penalty. So I just wanted you to be aware of that. It's not a required change, but if there's any interest in us making that change to give the KUA a little more flexibility in rehiring retirees, that's something that we can consider. No decision needs to be made today. I wanted you to be aware of the law change and give it some thought. And if there's any interest in changing that, we can. Does anybody have any questions about that and how it works?
Any questions?
Yeah, Scott, is there any reason we would not want to do that?
Maybe you don't want to rehire retirees.
But it still wouldn't force you to rehire them. It's just
No, it wouldn't. No, it wouldn't. It obviously would give the retiree and KUA a little more flexibility because, for the most part, if somebody's drawing a retirement benefit, they're probably not going to be willing to give up that retirement benefit in order to come back to work.
Yeah.
So obviously in this situation where somebody's at least 59 and a half, if you were rehiring them, they could continue to draw that benefit and also work. Well, again, give it some thought. It doesn't become effective till October 1st anyway. So whatever you all ultimately want to do, you can knock it around there and see what you want to do. You can't talk about it amongst yourselves between meetings though, remember that. All right, any other questions about that? The only other thing I had was just a question for Keisha. At the last meeting, where we remember we declared our expected rate of investment return for the next year, several years in the long term, the little drill that we do every year.
I sent the letter off.
You sent the letter, the pension letter number 1?
Yep.
All right, good. That's all I've got on my list, unless anybody has any questions for me about any other subject.
Any other questions for Scott? Thanks so much, Scott. Appreciate it.
You bet.
Okay, that brings us to new business. Anybody have any new business? Old business? There's no old business. Let's get down to the administrative agenda. And that's the expense report. Any questions on expense report? And in fact, if you accept it, could we have a motion to accept the expense report?
Motion to accept the expense report for February, March, and April of 2020.
We have a motion to accept the expense report for the last 3 months. Second?
Second.
Second. Any discussion? All in favor, say aye. Aye. Opposed, no. And it passes. Brings to the next item. Which is the minutes. So does anyone have any questions on the minutes or any changes that they would say, or if they agree, please give me a motion to accept the minutes.
Larry, this is Barbara. I do have a comment on the minutes. In the second paragraph under section A, fourth sentence, largest contributor is there twice. I think it only needs to be there once.
Is, okay, well, that be corrected. Does anyone have a motion? Is there any other corrections?
No.
I think Keisha does that just to see if you're reading the minutes.
So do I have a motion to accept the
I do that just
corrected?
to see if they're actually reading it.
Right, exactly.
Do I have a motion to accept the corrected minutes with the largest contributor removed?
So moved.
I have a motion. Do I have a second?
Second.
Motion second. Any further discussion? All in favor, say aye. Aye.
Aye.
Opposed, say no. And motion carries. Next item, the list. I think we're to the list.
Go,
Jason.
Jason.
Wow.
Is that Mike Regan going in the drop? Do I have a motion to accept,
I'll make a motion to approve the drop retirement for Mike Reagan in the amount of $4,930.98.
Second.
a motion and a second? Any discussion? All in favor, say aye. Aye.
Aye.
Aye.
Both say no. Next item, please.
Okay, Charles Lee. Make a motion to approve the drop rollover for Charles Lee in the amount of $67,354.47.
Second.
Second.
Second, any discussion? All in favor, say aye.
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 Both say no, and that's approved. On to the next.
And I'll make a motion to approve the early retirement of Candace Patel in the amount of $787.32.
Second.
A motion and a second. Any discussion? All in favor, say aye. Aye.
Aye.
Aye.
Opposed, say no, and that passes. Next.
Hello.
Now, we're to other matters, and I don't see other matters there.
None.
Does anyone else have anything to give? The only other matter I will give is when we adjourn this meeting, we'll reconvene, and is 5 minutes enough? Or do you want 10?
Five is fine.
Okay, we'll reconvene for our next meeting after this, and a motion to adjourn.
So moved.
Second from the chair, we are adjourned. I'll see you all in 5 minutes.
For me.
Thank you.
Thanks, everyone. Have a great day.
All right, bye. everybody.
August, hopefully live and in person.
Okay,
Yes.
good.
Take care.
Be well.